Ever wondered how to spot a market peak before it tumbles down into a downturn or bear market? Well, it's not as straightforward as one might think, but there are certain statistical indicators that can provide valuable insights. In the world of investing, these indicators act as the compass guiding investors through choppy market waters. Today, we're going to delve into some of these key indicators, comparing and contrasting them to help you understand their significance. First up, we have the price-earnings ratio, or PE ratio. This ratio compares a company's current share price to its earnings per share. When the PE ratio is high, it suggests that stocks may be overvalued, potentially indicating a market top. However, bear in mind that a high PE ratio doesn't always spell doom. It could also mean that investors are expecting high growth rates in the future. On the other hand, we have the Shiller PE ratio, also known as the cyclically adjusted price-to-earnings ratio, or CAPE. Unlike the traditional PE ratio, CAPE considers inflation-adjusted earnings over the past 10 years. This longer-term perspective smooths out short-term volatility and provides a more comprehensive view of market valuation. When the Shiller PE ratio is high, it's often a warning sign of an overvalued market and a potential downturn. Next, let's discuss the put-call ratio. This ratio is calculated by dividing the number of traded put options by the number of traded call options. An increase in the put-call ratio suggests that investors are starting to protect themselves against a potential drop in the market, indicating a possible market top. However, this indicator can be tricky to interpret, as a high put-call ratio can also be a sign of a market bottom due to excessive pessimism. Moving forward, we have the Volatility Index, or VIX. This index measures market expectations of near-term volatility conveyed by S&P 500 stock index option prices. When the VIX is high, it indicates that investors expect significant changes in the market, often associated with market tops or downturns. Yet it's important to note that the VIX is a measure of expected volatility, not an indicator of market direction. Lastly, the yield curve, specifically the spread between 2- and 10-year Treasury yields, is another valuable indicator. An inverted yield curve, where short-term yields exceed long-term yields, has historically been a reliable predictor of recessions. Though it's crucial to remember that an inverted yield curve doesn't cause recessions, it's merely an indicator of economic sentiment. In conclusion, no single indicator can predict a market top or downturn with absolute certainty. It's the combination of these indicators, alongside an understanding of market fundamentals and economic conditions, that can provide a holistic view of where the market might be heading. Remember, investing is not about predicting the future, but about making informed decisions based on available evidence. Stay sharp, stay informed, and always keep an eye on these statistical indicators. They might just be your best ally in navigating the turbulent seas of the investment world.